Keith Taylor, come here now and step away from the donor desk.
I'm coming. See, I'm not giving you any trouble at all. I hear you, and I'm going to make this easy for everybody. I've always respected what you all do.
More than $2.5 million from donors meant for families in crisis.
There are two versions of Keith Taylor: the charity founder who told donors he was changing lives one emergency at a time, and the man on the federal indictment who spent over $320,000 of those donations at the most expensive restaurants in New York City. Both are the same person.
I just want it on the record that I cooperated from the very first second. That matters, right?
He would keep spending even after they left. Federal agents walked through his 30th floor apartment on a June morning in 2024, carried out 3 computers and 11 boxes of records, and delivered a set of release conditions that barred him from touching a single dollar of the charity's money. That afternoon, Keith Taylor ordered dinner delivery on the foundation's account. $2.5 million stolen. 23 years running a non-profit that promised to keep working families from losing their homes. And a board of directors that existed only on paper he wrote himself. Real talk before we go any further. Have you ever given money to a charity and just trusted the name on the envelope? Drop that story in the comments. And subscribe if you are new here. We cover accountability stories like this every week, and this one gets worse the deeper we go. Keith Taylor was born in 1967 in Erie, Pennsylvania, the second of 3 children in a middle-class household on the east side of the city. His father, Raymond Taylor, worked as a shift supervisor at a General Electric plant that built locomotives. His mother, Elaine Taylor, was a registered nurse at St. Vincent Health Center. Neighbors remembered the Taylors as reliable and quiet, the kind of family that paid its bills early and mowed the lawn on Saturday mornings. Keith was the reader in the family. His sister would later tell interviewers he had a paperback in his hand every summer. He collected library slips the way other kids collected baseball cards. By high school, he was working weekends at a used bookstore on West 8th Street, shelving hardcovers and building a reputation among the owners as the kid who could recite the entire inventory from memory. He graduated from Cathedral Preparatory School in 1985 near the top of his class. He enrolled at Penn State University that fall on a partial academic scholarship, studying English literature. His grades were consistent. His professors described him in written recommendations as thoughtful, articulate, and generous with his time. He tutored freshmen for no pay. He volunteered at a community literacy program in State College 1 evening a week for 4 years. After graduation, Taylor stayed in academia. He completed a master's degree in English at the University of Tennessee, then a doctorate in 19th century American literature. He accepted his first teaching position at a small liberal arts college in upstate New York in 1994. His starting salary was $31,000 a year. He lived in a rented 1-bedroom above a hardware store. He drove a used Honda Accord with a manual transmission. His teaching evaluations from those years survive in personnel files. Students described him as challenging, patient, and unusually available. One review from 1997 called him the professor who actually returns emails at 3 in the morning. Another said he stayed after class to explain a Melville passage until every hand in the room went down. A department chair wrote that he demonstrated a rare combination of intellectual rigor and genuine warmth. In the late 1990s, Taylor began writing about poverty. He read every study on financial insecurity he could find. He was fascinated by a specific category of hardship: the working poor, people who held down jobs, paid taxes, and stayed off government assistance, but who were still one broken transmission or one emergency room visit away from losing everything. Traditional charities, he argued in a 1999 essay, ignored these families because they earned too much to qualify for aid and too little to save. He drafted a proposal, a crowdsourced foundation funded by small donors that would step in with one-time grants when a working family faced an unexpected expense they could not absorb. $200 for a car repair, $400 for a utility shutoff, $600 for a security deposit, small amounts, life-changing consequences. In 2002, Taylor left his teaching position and moved to New York City. He filed the incorporation paperwork for Modest Needs Foundation on March 4th, 2002. He was 35 years old. He had $6,000 in savings and a rented studio apartment in Astoria. He worked on the launch for 8 months without a paycheck. When the website went live that autumn, it drew a modest wave of attention from small blogs and one segment on a local morning show. The response was slow at first. Then, in 2005, Oprah Winfrey featured the foundation on her show. Donations flooded in. Within a year, Modest Needs had disbursed over $400,000 to families across all 50 states. The organization hired its first employee. Taylor became the public face of the mission. He gave interviews on cable news. He testified before a Senate subcommittee on poverty in 2007. He was named to a Time magazine list of American social innovators. For a decade, the story held. The foundation grew. Taylor's compensation, disclosed on the annual tax filing, sat modestly at around $90,000. He told reporters he lived on ramen and library books. He told donors every dollar not spent on overhead went to the families who needed it. But behind the public numbers, Taylor was already building something else. Somewhere between the Oprah appearance and the Senate testimony, the man who lived above the hardware store and drove the used Accord had developed a taste for a different kind of life. To understand what came next, you have to understand how a small nonprofit actually works. Modest Needs Foundation was a 501c3 public charity registered with the Internal Revenue Service and the New York State Attorney General's Charities Bureau. That designation carried specific legal obligations: an annual Form 990 tax filing, audited financial statements above a certain revenue threshold, a functioning board of directors with fiduciary responsibility over the executive. The board was the safeguard. In theory, a nonprofit's board is the mechanism that keeps the executive honest. Board members review the budget. They approve major expenses. They set the CEO's salary. They demand explanations for irregular transactions. When a nonprofit fails, the board is supposed to be the layer of accountability that catches problems before they metastasize. Modest Needs listed a board on its Form 990 every year. The forms named directors with titles and terms. The organization's website featured a page with photos and biographies. To donors reviewing the charity on Charity Navigator or GuideStar, the governance section looked complete. But the crowdsourcing model created a particular blind spot. Modest Needs raised money almost entirely from small individual donors, thousands of them, each giving $20 or $50 or $100. No single foundation grant came with the kind of oversight strings that large institutional funders attach. No wealthy trustee had personal capital exposure. No corporate sponsor demanded quarterly reports. The donors who kept the lights on had no practical way to audit how their money was spent, and they had every reason to trust the man on the television telling them it was going to families in need. The financial architecture was equally forgiving. The foundation used a single primary operating account at a national bank. Taylor had sole signatory authority. He was the CEO, the treasurer in practice, and the person who reviewed and approved his own reimbursement requests. The outside accountant hired to prepare the annual tax return worked from documents Taylor provided. She never saw the underlying bank statements unaltered. She never spoke to a board member. She had no reason to. Every nonprofit she worked with functioned the same way, on trust. Trust was the whole model. The pitch to donors was that a small, lean organization with low overhead could get money to real families faster than a bureaucratic legacy charity. Trust was also, as it turned out, the entire vulnerability. Taylor sat at the top of an organization that had almost no internal check on his behavior. There was no CFO. There was no independent auditor with account access. There was no board member who could log in to the bank portal. The Internal Revenue Service and the New York Attorney General relied on the annual filings to flag problems. But the filings were prepared by the man being flagged. The board approving them did not exist. The theft did not begin as theft. Investigators would later trace the first questionable charges to 2015, small at first. Restaurant meals categorized as donor cultivation expenses. A dinner at a midtown steakhouse. a lunch at a bistro on the Upper West Side. Each receipt filed away and coded to a legitimate-sounding budget line. By 2016, the pattern had shifted. Taylor started dining alone and charging the foundation. He would arrive at Jean-Georges at Columbus Circle on a Tuesday afternoon, order a tasting menu with wine pairings, and leave a bill of $400 or $500 on the foundation's card. There was no donor across the table. There was no meeting. The receipt would be logged as a strategy meeting or a stakeholder consultation. There was no one at the foundation to question it because there was no functioning board and no independent finance staff. The escalation was gradual but relentless. In 2017, he ate at Per Se twice in the same week. In 2018, he opened accounts at Masa, the sushi restaurant on the 4th floor of the Time Warner Center, where a single seat cost $700 before beverages. He began ordering delivery from Maria on Central Park South 2 and 3 times a week. He added an account at Le Bernardin. He added an account at Daniel. Federal prosecutors would eventually document more than $320,000 in charity funds spent at restaurants alone. The apartment came next. In 2018, Taylor signed a lease on a 30th floor unit in a luxury tower on West 57th Street. The rent was over $8,000 a month. The foundation paid it, every month, for 6 years. More than $300,000 in charitable donations, funneled through the foundation's operating account, went to a landlord whose tenant was living in a 2-bedroom with floor-to-ceiling windows and a view of Central Park. The food delivery bills alone crossed 6 figures. Investigators pulled records from 4 separate delivery services and found orders placed almost daily, sometimes multiple orders on the same evening. Steakhouses, Italian, Japanese, groceries from a specialty market on Broadway. The charity was paying for a man to eat. Then came the transfers. Beginning in 2019, Taylor started moving foundation money directly into a personal brokerage account. Small amounts at first, coded as consulting reimbursements or contractor payments. Then larger. By 2023, the total had reached approximately $270,000. He used the brokerage account to trade individual stocks and hold cash reserves. He was investing charity money in his own name. The medical bills followed the same route. Foundation funds paid for dental work, for elective procedures, for prescription co-pays. He billed the charity for gym memberships and dry cleaning and a personal trainer. He billed it for haircuts at a salon on Madison Avenue where the standard cut ran $95. He billed it for wine club subscriptions. In one 12-month period, prosecutors identified over 1,100 separate personal charges on foundation accounts. The lifestyle was visible to anyone who looked. Taylor was photographed at fundraising galas in tailored suits. He hosted small dinners at the apartment. He traveled. He gave speeches about serving the working poor while sitting in a chair a working family could not have afforded to look at. And no one asked, because no one could. There was no board. That was the piece he had been building the longest. To keep the Form 990 filings clean, Taylor needed names to list as directors. He needed people who would appear on paper as the oversight body approving his salary and his expenses. So he invented them from his own life. He listed a bartender he knew from Jean-Georges. He listed a longtime personal friend from Queens. He listed the woman who cleaned his apartment twice a month. None of them were ever told. None of them attended a meeting. None of them signed anything. The board that was supposed to catch him was 3 people who did not know they had jobs. We are heading into the investigation now. If you want to see exactly how the system finally caught up with him, subscribe. We break down every detail of the evidence, the arrest, and the sentence. And this one has details that will make your stomach turn. For years, the scheme had a structural advantage. Modest Needs was small enough to avoid the routine audits that hit larger charities, and Taylor was careful enough to keep the paperwork looking plausible. But the IRS runs analytical filters on nonprofit filings, and in early 2023, one of those filters flagged modest needs. The trigger was not the spending. The trigger was the missing tax payments. Taylor had been paying himself far more than the $90,000 listed on the Form 990. The unreported income showed up as a mismatch between the foundation's disbursement records and the personal tax returns Taylor was or was not filing. Between 2015 and 2023, prosecutors would eventually calculate that Taylor evaded more than $1 million in federal income tax. The IRS Criminal Investigation Division opened a case file in the spring of 2023. Special agents began quietly subpoenaing bank records. They pulled the foundation's operating account statements. They pulled Taylor's personal accounts. They pulled the brokerage records. They pulled restaurant billing data. What they saw within a matter of weeks was the outline of a charity that had been operating as a personal expense account for the better part of a decade. They took their findings to the United States Attorney's Office for the Southern District of New York. The Public Integrity and Complex Frauds Unit picked up the case. Prosecutors expanded the scope. They subpoenaed the landlord of the West 57th Street building. They subpoenaed the delivery services. They subpoenaed the brokerage. They interviewed the outside accountant who prepared the Form 990 filings, and then they made the call that broke the case. They asked to interview the members of the board of directors. The list of names on the most recent Form 990 was short. The prosecutors reached out to each one. The first was the personal friend, a small business owner in Queens. He told the agent on the phone that he had no idea he was listed as a director. He said Taylor had never once discussed foundation business with him. He asked what a Form 990 was. The second call went to a bartender at Jean-Georges. Same answer. He said he had served Taylor drinks for years and considered him a regular, but had never been asked to serve on a board of anything. The third call went to the housekeeper. She had cleaned Taylor's apartment for 6 years. She had never been told she was a director of a national charity. She did not know what a fiduciary duty was. She had never seen a budget. She had never voted on anything. The prosecutors now had it. Not a paperwork error. Not an accounting dispute. A deliberate, documented, years-long fraud built on directors who were never directors. The oversight structure required by federal tax law had been fabricated. The safeguard that was supposed to protect thousands of small donors was fiction. They took the case to the grand jury. The indictment was returned under seal in the late spring of 2024. It charged Keith Taylor with wire fraud and 8 counts of tax evasion related to more than $1 million in unpaid federal income tax. The wire fraud count alone carried a statutory maximum of 20 years in federal prison. The evidence file the prosecutors had assembled by that point ran to tens of thousands of pages. Bank statements from 4 institutions, brokerage records covering 9 years, restaurant billing detail from more than a dozen establishments, delivery service order histories, tax filings for the foundation, personal returns filed and not filed, emails pulled from the foundation's server pursuant to a search warrant. The email trail was particularly damaging. Investigators found a message from Taylor to himself in 2019 that read like a personal budget spreadsheet. It listed his monthly personal costs. Rent, $8,300. Food, $4,000. Brokerage transfers, variable. It ended with a single line at the bottom. Source, MNF Operating. MNF Operating. The Modest Needs Foundation operating account. He had written down, in his own hand, the fact that his personal cost of living was being paid by the charity, and he had stored the document on the charity's server. There were text messages. One exchange from 2021 with a personal contact, recovered from Taylor's phone under warrant. Contact, October 4th, 2021. Where should we do dinner Friday? Taylor, Maria, on the foundation. Contact, ha, nice. Taylor, every bite tax deductible. Another exchange from February 2022. Taylor, February 17th, 2022. Just booked a new tasting at Masa Contact. How much, Taylor? $950 with wine. Contact. For yourself, Taylor. The board approved. The board he referred to did not exist. The joke was between him and one other person. It was written down. There were more spreadsheets. investigators recovered a document showing dining reservations coded by which foundation budget category the meal would be booked against. There was a note to self about which brokerage transfers to characterize as reimbursements versus contractor payments to avoid attention. The forensic accountants working the case built a reconstruction of the charity's actual spending versus its reported spending. The numbers were brutal. Over the 9-year period, more than $2.5 million had flowed out of the foundation's operating account and into expenses that had nothing to do with helping working families. Over the same period, the foundation had disbursed grants to actual applicants at a rate lower than what was publicly claimed. Every dollar Taylor spent at Per Se was a dollar that did not reach a family behind on rent. The victims were harder to identify individually because of the crowdsourcing model. There was no single defrauded investor. There were thousands of small donors, each of whom had given $50 or $100, believing it was going to a specific family they had read about on the foundation's website. Prosecutors did not attempt to name every donor, but they documented several who agreed to be identified. A retired nurse in Ohio who had given every month for 11 years. A school teacher in Michigan who ran a classroom giving campaign with her fourth graders. A widow in Florida who had donated her late husband's memorial gifts. Their money had bought sushi. On the morning of June 12, 2024, federal agents assembled in the lobby of the West 57th Street Tower. They had an arrest warrant and a search warrant. The building's concierge was informed and asked to hold the elevator on the 30th floor. At approximately 7:14 a.m., 3 agents from IRS Criminal Investigation and 2 from the FBI knocked on the door of apartment 30C. Taylor answered in a bathrobe. He was holding a coffee mug. The lead agent identified himself and produced the warrant. Taylor read the top page and set the mug down on a side table. Agent, Mr. Taylor, we have a warrant for your arrest and a warrant to search this residence. Do you understand what I just said? Taylor, I understand. Agent, is there anyone else in the apartment? Taylor, no, just me. Agent, we are going to need you to step into the hallway, please. Taylor, can I put clothes on? He was escorted to the bedroom with a female agent present, permitted to dress, and brought back to the living room. The search team began working through the apartment room by room. They found what they were looking for on the desk in the second bedroom, which Taylor had converted into an office. 2 laptops, a desktop tower, a printer, filing cabinets, and a manila folder labeled MNF in blue marker containing printed statements and handwritten notes. Taylor watched from the couch for nearly 2 hours. He did not ask for a lawyer. He did not make a statement. At one point, he asked one of the agents if he could order coffee delivery for the team. The agent thanked him and declined. When it was time to leave, Taylor was placed in handcuffs. The lead agent walked him to the elevator. As the doors opened on the ground floor, Taylor looked at the agent and said one thing. Taylor, the board approved everything. You should talk to the board. The agent did not respond. He already had. Taylor was arraigned that afternoon at the federal courthouse at 500 Pearl Street in Lower Manhattan. He entered a plea of not guilty. He was released on a $250,000 personal recognizance bond with conditions. He was ordered to surrender his passport. He was ordered to have no contact with the Modest Needs Foundation's accounts, records, or remaining staff. He violated those conditions within days. Prosecutors would later document that Taylor continued using foundation-linked cards for personal expenses in the weeks after his arrest, including additional restaurant charges and at least one payment on the West 57th Street apartment. The pretrial services officer assigned to his case filed a violation report. The court modified his conditions to require full financial monitoring. The spending finally stopped. The case moved toward resolution for 14 months. Taylor's defense counsel filed motions to suppress evidence obtained from the foundation's server, arguing that Taylor had a personal expectation of privacy in emails stored on the charity's system. United States District Judge Jennifer L. Rochon denied the motions in a written opinion. The defense filed motions challenging the tax loss calculation. The the court denied those as well. On August 18, 2025, Keith Taylor entered a change of plea hearing before Judge Rochon in the Daniel Patrick Moynihan United States Courthouse. He pleaded guilty to 1 count of wire fraud and 8 counts of tax evasion. Under his plea agreement, he acknowledged responsibility for embezzling more than $2.5 million from Modest Needs Foundation and its donors, and for evading more than $1 million in federal income tax between 2015 and 2023. His allocution was brief. He told the court that he had breached the trust of the foundation's donors and the families the foundation was intended to serve. He said he accepted responsibility. He did not offer an explanation for why the theft had continued after his arrest. Sentencing was scheduled for December 10, 2025. The government's sentencing memorandum requested a term at the upper end of the applicable guidelines range, citing the abuse of a position of trust, the sophisticated means employed through the fabricated board of directors, and the victim impact on thousands of small donors and the working families they had believed they were helping. The memorandum quoted the retired nurse from Ohio, who wrote in a victim impact letter that she had given every month for 11 years because she believed she was helping people like her own daughter, and that the discovery of the fraud had made her question every act of generosity in her life. Judge Rochon addressed the courtroom before adjourning the plea hearing. She said the case represented one of the most cynical betrayals of charitable trust that had come before her court. She said the defendant had not merely stolen from a charity. He had stolen from the idea of a charity, from the belief that small donors pooling small gifts could produce something larger than themselves. She said the sentencing court would weigh not only the financial loss, but the damage done to public confidence in the nonprofit sector, and that the deliberateness of the scheme, sustained over nearly a decade and built on a fabricated board of directors, left little room for leniency. Taylor faces a statutory maximum of 20 years on the wire fraud count and 5 years on each tax evasion count, though federal sentencing guidelines and the plea agreement will produce a lower recommended range. Restitution to the foundation and its donors is expected to be ordered at the full documented loss amount of more than $2.5 million. Whether that money can ever be recovered is unclear. The foundation itself, stripped of its founder and its funding, ceased operating in 2024. Its website now displays a single notice. Modest Needs Foundation is no longer accepting applications. The retired nurse in Ohio has not given to another charity since. This case was hard to watch, but the case on the right-hand side of your screen is even more brazen. Click it now.